We often talk about the market as if it's this just amorphous blob and not get into the fact that the market is made up of individual companies. And sure, you can buy an index, exchange traded fund and not worry about picking stocks, but any savvy investor will tell you that the best way to make money is to try and identify the companies that are doing well, that are primed for growth, so that you don't have to worry about broader economic conditions all the time. So joining me, David Katz, Matrix Asset Advisor, and Paul Dietrich of Foxhall Capital Management to talk about some of the companies that they own in their portfolios right now that they still like for the end of 2011 and beyond, despite all the volatility. David, start off with some of the companies that you like. You've mentioned that the merger boom that we've had in 2011 will continue and that there are some companies that you think are primed to benefit possibly from takeover speculation.
Right, so when we buy stocks, we're looking for superior companies, superior growth prospects, good management. But one of the things that we find is if we're buying them at a discount to what we think they're worth, other companies can come in and buy them as well. We think M&A is going to pick up as the year continues, and a number of our holdings, like a Harris Corp, make enormous sense to be owned by a bigger competitor, by another defense-type contractor. So we'd say Harris, number one out there. We think on the financial side, some of the banks could be vulnerable, although you're not going to get a lot of premium there. Zimmer Holdings, which is in the medical products area, makes enormous sense to be owned by a bigger player. We're expecting a consolidation in the paper industry, in the paper supply industry, like a Staples, ultimately might get caught up in an M&A transaction as well.
Paul, do you look at mergers and acquisitions as a possible reason to own stocks in your portfolio? There have been a lot of cross-border deals in the past year, companies outside of the U.S. buying American firms and vice versa.
The two areas that I'm really looking at, especially in Asia and emerging markets, are consumer products and consumer services. And then in the larger global issues, I believe that commodities are important because I just see inflation coming up because of our spending policies in Washington and the deficit and the printing of money. And I think that will continue. And so commodities are a really important part of our strategy. I like oil companies. CNOOC, the Chinese oil company, is a favorite. I also like a lot of companies in Latin America. We're seeing real value plays down there from spectacular companies. American Mobile, which is the telecom company,
right, Carlos Slim.
Carlos Slim has a low PE, moderate PE, high cash flow, high return on equity, and they have more subscribers than both AT&T and Verizon combined, and they're now just getting into the smartphones, so they're going to be able to charge for data. And so I see real profits coming in the future as this starts moving. InBev is the Pepsi and beer distributor biggest in Latin America. Great company, low PE, high cash flow. This is a real consumer play that Americans can invest in.
What do you think? Do you think also, David, that some consumer-oriented companies are the way to go, especially at a time in the U.S. when many average Americans are hunkering down, worried about just paying the bills?
Well, the consumer stocks have actually had a great 6 months, so we're expecting less for the back half of the year. So we own Procter & Gamble, we like Procter & Gamble, but we think they're better places to put money. We look at some of the laggards in the first half of the year as places for the back half of the year. Some of the technology companies have not done particularly well stock price-wise, although their businesses have done well. So a company like Corning Glass, very well positioned for the next few years, sells under 9 times earnings.
Right, and there is a consumer play there with television.
That is a consumer play, although it moves more with technology per se. The banking group has been miserable in the first half of the year. We think that the business trends are better, and as soon as some of the headline risk disappears, those stocks are poised to do a whole lot better in the back half of the year. We like Wells Fargo best, JP Morgan, MetLife, which goes back to Japan, has a lot of Japanese exposure at this point, would be a few that we think are very well positioned.
Right. Paul mentioned also commodities and expecting that commodity prices will rise again, depending on what day of the week it is. Goldman Sachs may or may not say that it's time to buy or short commodities. What do you think about commodities right now? Do you own any big oil stocks right now?
Well, we think commodities are going to do okay in the back half of the year, but you can buy stocks. So going back to the consolidation theme, I didn't mention Alcoa. We think ultimately Alcoa makes a great deal of sense to be owned by a bigger metals and mining player, but we think on the fundamentals itself and on their earnings themselves, The stock should be $23 to $25, so you've got about 40 to 50% upside. We do like the energy companies. We like companies like a Chevron or a Conoco, and also like Devon here.
I'd like to just go back on commodities. I think commodities are going to start going up again in the fall. We're seeing in car sales in China, and now unbelievable growth in car sales in India. 28% probably in China that it will go up this year over the United States sales. And so we're going to see demand for oil continue to pick up. And I believe that this is a demand-driven issue, and I think oil prices are going to continue to go up, and I think oil prices for the oil companies for the long run, like Exxon and CNOOC, are companies that you want to have in your portfolio.
All right. Well, David and Paul, thank you so much for joining us. It'll be very interesting to see if the latter half of 2011 is as interesting and intriguing as the first 6 months were.
Thank you.
Thank you.